Let's talk about the optimal way to structure your wealth in retirement. Now, I'm going to take you through a few different scenarios, starting with scenario 1. And we're going to look at the retirement from an income, tax, and cost perspective, both now and in the future, most likely in inheritance for your children. So the first scenario 1, is what I would consider an optimal structure for the use of wealth. So the client has a $2 million primary residence. They've got $3.8 million in their pension accounts. So it's a couple. So they've each got $1.9 million in their tax-free pension account, which is the maximum that you can have. Next, they've got $1.2 million in Australian shares. And the reason why they've got that is that if this was to earn a 5% income yield, then it would generate $60,000 a year of returns, and each client can actually have $30,000 a year tax-free when you consider the seniors and pensioners tax offset. Plus, Australian shares also allow for franked dividends refunds, which gives them extra money that the companies have already paid in corporate tax at 30%. Next, the clients could have $500,000 in superannuation in an accumulation account, and this would be taxed at 15% on the earnings. And that's essentially the overflow amount for their total $7.5 million wealth. Now, the reason why this is a really good structure is when we look at the amount of income that it's producing, $5.5 million of the assets are income producing assets, and only $2 million of the home is not. So they can generate a really considerable amount of income. Next, when we look at the tax implications, we know that there's no tax in these pension accounts and unlikely to be in the share portfolio as well. In fact, probably a refund. And then in superannuation, it's just a nominal 15% tax on the earnings of that $500,000 portfolio. So it's really good from a tax perspective. It's also really low cost. And I'll compare that against the scenarios where there's more property involved to show you some of the differences as well there. So that's the tax and income implications now. But if we fast forward to inheritance, and assuming this couple give their adult children the wealth that's left over at the end, then let's look at the tax and cost implications at that point. So family home, $2 million, if that's sold within the first 2 years, then typically it's capital gains tax-free for the children beneficiaries. The pension account, there is a tax for non-tax dependents, which most adult children are, of 17% of the taxable component within super. However, the important part to note is there are strategies to reduce that taxable component down quite significantly from age 60 to 75. So we can get a good outcome from a tax perspective for the pension and super account because they've got the same taxation treatment. Then the shares, when they're inherited by the adult children, they don't pay capital gains tax when received and only when sold. And because shares are quite liquid, which means that you can sell smaller parcels at any point, they're quite easy to be kept by the children, and they can sell manageable portions to not trigger too much capital gains tax. Shares are also good because they don't have the same amount of ongoing costs that properties do, so it's easier for the children to actually retain those shares if they wish, and they can obviously get their own financial plan done with the inheritance at that point. So for income, tax and costs, both now and in the future, this scenario is what you would consider an optimal scenario. Now let's look at scenario 2. This is the classic asset-rich, cash-poor scenario. This client just has a $7.5 million primary residence. So it could be in a really premier suburb in Australia, and they're just living off age pension. Now, the problem with this scenario is that the rates on a $7.5 million house are going to be around about $15,000 a year. Now, full age pension for a couple is only $40,000 a year. So they really can't live off $25,000 a year. No one really could. So that's not a good outcome. From a tax perspective, sure, it's fine now and also in the future because the kids can sell that in 2 years, but it doesn't meet the income aspect at all. So that's not going to be an option that's going to work for this client. The third scenario, this is one where the client has a $1.5 million primary residence and the rest in 6 investment properties, all equal to $1 million. So they have $7.5 million as well. Now, from an income perspective, sure, it's going to be decent generating income now. The problem is the tax. Because it's not in the superannuation or pension environment, we're going to pay a significant amount of tax here. So if this is making a 4% income yield, these investment properties, then that's about $240,000 of income. So $120,000 to each member of the couple, which would be $30,000 a year each, or $60,000 a year as a couple. So imagine that for 20 years, that's $1.2 million extra tax that this couple's paying than potentially these ones. So it's a really significant burden. Now, when we look in the future, we know primary residence sold within the first 2 years, unlikely to be capital gains tax. But the problem with gifting all these investment properties to adult children is, firstly, it's a nightmare from an estate planning perspective, because if you've got multiple children, these investment properties are likely to be all valued at different amounts. In this situation, I've made it really simple, each the same value, but they're unlikely to be. So it's really hard to make an equitable split. Secondly, it's hard for the children to retain that asset because property has a lot more ongoing costs. So things like rates, land tax, tenant costs, all those sorts of things. So it's almost forcing the kids into selling that property straight away, and therefore incurring a significant capital gain, because again, it's not a liquid asset like these shares. So you can see here, whilst that's okay from an income perspective, from a tax and cost perspective, now and in the future, it's not ideal. So obviously with these scenarios, not everyone has $7.5 million to retire, but I think people would be quite surprised the amount of wealth that people that are retiring soon have actually accumulated, because most people have had compulsory super since the early 90s. So super balances are really healthy these days for people looking to retire, as well as phenomenal property growth rates in the last 40 years, and low interest rates relatively has made people in this cohort that are about to retire quite wealthy. But even if you're not worth $7.5 million, that's completely fine. It's all about making sure the mix between what you've got in your primary residence and investable assets that are in a tax effective structure is the right mix for you. So if you had $2, $3, $4 million, whatever it might be, many of the same principles still apply. It's about making sure you've got enough income and the tax and costs are low, both now and in the future. We can't move this to this structure or this structure to this structure overnight, because we've got huge capital gains tax implications. We've got yearly contribution cap rules into super as well. So ideally, if you're looking to retire in the next 10, maybe even the next 15 years, then that's when you should be reaching out to a financial planner to get this sorted, so that you can get more of this type of scenario and less of these. So if you need help with any of that, please reach out.